So the idea here of this panel is to take all this information that you've been given over the last 6 hours and try to synthesize it down to, so now what do we do? So we're going to talk about strategies for 2018 and beyond. What do we do in the real estate markets? And we've put together what I think is a really interesting mix of people by background and strategies and experience. So just to set the stage, when I describe who you are, I think you'll figure it out. Raise your hand. So we have someone who was born in the United States, currently works in Germany. Jason, thank you. We have someone who was born in Germany, currently works in the US. We have our Southerner, and we have our Canadian. So it's a very interesting mix. So we'll start on the side. Cord is born here in Germany, working in the US for Wafra Residential Value Invest, raising money in Germany to invest in US multifamily, based in New York. Jason, born in Florida, and I'll tell you, Jason, you talk to Jason, his English is like impeccable. But you moved from Florida to Germany when you were how old?
6 years old.
Your English is fantastic. Anyway, so born in Florida, now working for HANSAINVEST, head of portfolio management based in Hamburg. David, whom I've known for, we tried to figure this out last night, more than 20 years. Yeah. He was the acquisition team for TMV, the Munich-based advisor to German investors. When we first met, he's now still based in Atlanta as a managing director of GTIS Partners. Some of you, if those of you who were here last year, heard David talk about single family for rent. And then we have Ted Willcocks, who's the global head of asset management at Manulife, which is a Toronto-based insurance company which owns John Hancock Insurance in the US. And so among Ted's other duties, he oversees a very large portfolio of real estate assets in the US. So we'll get, for those who want to talk about Canada, grab Ted afterwards. He can tell you everything we want to know about Canada. But today we're talking about the US, Ted. I think I start with this issue. We've covered a lot of this in the prior discussions. But what we haven't talked a lot about is what US investors are doing in the US. We had a little graph about allocations. Ted, you're calling on US, you're meeting with the US investors regularly. Do you see a shift in the way they're looking at the US? We heard a lot of information about risk, opportunities, whatever. What's your sense as you talk to US institutional investors?
Well, Brad, I think what's interesting in this current environment, we've had some great data this morning, is that U.S. investors are armed with an incredible amount of data, more so than they've ever been in the past several years. We've had quite a run in terms of our post-GFC, returns over the last 8 or 9 years. And I think investors in the U.S. are really trying to seek direction as to where this market, how long it continues in terms of the run that it's had. I mean, you have the wall of capital that is facing and propping up some of the prices in the U.S. You don't have the China bid anymore in the States. But I think people are, I would say this is a good opportunity for foreign investors because there's not as much competition around the bid right now. And if you look, people are concerned somewhat about inflation. They're concerned about rate hikes. So I think a slight pause here is what investors are looking at. They're digging down in their strategies. They're looking more for value add and more for opportunistic.
David, on that question of rate hikes, and my sense, I made myself very unpopular here about 3 weeks ago when I was at a conference and I referred to Germany as the new Japan. And by that I meant the fact that the sense I have in Germany right now is that rates are going to stay low for a long, long time. And that investors are making their real estate decisions on the basis of the fact that they believe rates will stay low, long, long time. David, in the US, we're past that. We thought that 4 years ago, we thought long rates were going to go up.
Right.
3 years ago, we thought they're going up. Now they're going up. What's your sense of how US investors are reacting from a strategy perspective now that rates really are going up?
Yeah, it's hard. I would say it's a little too early to tell, truly. We've been more active lately in the multifamily space, where that space, I'd say, is half of the participants are fairly leveraged using the agency debt that's out there. Agency debt's moved from roughly longer term interest-only debt, roughly 3.5%. That same debt today would be about 4.25%. So you're a little less. So you've moved maybe 60, 70 basis points. So you would think that would have an impact on valuations and what people are willing to pay. But there is still a big segment of people, especially high net worth buyers, that are in the market, more in the smaller transactions, and institutions on bigger that are still, they're either low leverage or no leverage, so they're not as impacted. So I think it's a little too early to tell. We've been hearing anecdotally just in the last weeks on deals that are not meeting buyers' expectations there. So that may be an early signal that maybe there is some movement or pause at least, and not as aggressive bidding as there has been in the space. So we'll see. I do think mentally, if the long-term treasury goes over 3%, I think that's going to have some sort of psychic impact to the market where there'll be a pullback.
Yeah, that was an interesting comment, that 3 may be the magic number. I would have thought it was higher. I would have thought we needed to be above 350, maybe closer to 4 before it really felt different. Cord, does it affect your strategy in the U.S.? Where is the significant break point in terms of interest rates before you start to look at repricing the assets you're buying?
I mean, the last deals we bought, we just closed the deal in Boston, core multifamily deal, and we put 6% leverage on it, 7-year debt at 3.6%. I think if we would reprice it now, 3 weeks later, we would be at 4.1. I don't think the 40 bips makes a big difference right now. I think if you look at 100 bips, maybe, but then you'll have to look at the banks, insurance companies. Are they lowering their spreads at the same time? So interest rates go up, maybe spreads go lower. I mean, we have to see that. I mean, you talk to a lot of intelligent people, what's the correlation between cap rates and interest rates, and everyone gives you a different answer. I mean, at some point of time.
There is one.
See. Yeah, if some point of time.
What do we say this?
They will go up, but as of right now, we would not really change our strategy.
Yeah.
I mean, we would.
Ted, you were about to say.
I'll just say this: if CBRE quote is 70 basis points increase in cap rate for every 100 basis points in
Right.
so
Treasury.
So,
But I would argue that they don't move up in unison. And so we need from my perspective, we need a jump in the treasury rate, and then the cap rates will follow, but with a lag time of 3 to 6 months, I think.
and even longer, it could be 12 to 18 months, depending on the prediction.
And depends on how much capital is coming in that is, as Dave was saying, unlevered.
Yeah, so traditionally we've been looking at the fact that there's been enough cushion in the spread, and the reality, Brad, is as treasuries push over 3, does that cushion still provide the resilience?
Yeah, I think there's going to be, sorry, just one other thought is just, I
You
think
don't have to apologize to interrupt, Dave. We're talking.
Yeah, I think it's going to take a little time. I think buyers are testing it right now, and so buyers are clearly tired of paying rich prices, and they're hoping for some pullback, and they may test it in this way, and then if they don't get it, they're going to push ahead, and so I think there's going to be a little bit of give and take for a while to see where the capitulation ultimately lies.
Yeah, and I think it's on both sides. So
Right.
sellers are holding out for last year's deal, and
Right.
when they don't have 35 bidders bidding what last year's numbers are, they revisit and they decide they're either going to hold the asset or sell it. Jason, you've been, I would say Hansa has this core U.S. multifamily strategy. Just walk us through a little bit about, this is now a strategy that goes back almost 2 years, I guess, 18 months from when you really looked at it. Tell us a little bit sort of the thinking in Hamburg about U.S. multifamily core with all that's been happening. How's it affecting the thought process internally in Hamburg?
The environment definitely has changed in the last 18 months. You're totally right on that issue. When we started looking at the U.S. again,
Again, and again.
and again. We originally were
That's an
looking
inside joke. I
at,
apologize for that, but we have a long history.
we were looking at a mixed use strategy, including office and logistics, as well as residential. And then we focused the difficulties in Germany, especially, buying good quality stock real estate, residential real estate. for really low cap rates below 4, around 4%, we thought it would be might be a good idea to invest in the U.S. in resi, because the cap rates back then for core product were above 4%, and we had cheap money, and interest rates were low, and that was a quite appealing strategy. And like I just mentioned, the last 18 months, the environment has changed. There still are a few assets around that are quite interesting, but it's getting more difficult when we're looking at cap rates below 4 and having
Cap rates below 4 and interest rates up.
And interest rates going up. And like Dave just mentioned, that was our last experience we had too when we were bidding in the bidding process. The interest rates we had were about 4.1% for a long-term loan. And that's quite difficult for a German investor, a long-term investor, to have positive returns.
But on the other hand, I mean, rising interest rates only happen if the economy is growing. So on a multifamily space, if the economy is growing, should translate into wage growth, and that should translate, hopefully, into higher rental rates. So yes, interest rates go up, but hopefully you're able to push your rents accordingly, which should offset some of the negative impacts of rising interest rates.
So we have 3 variables, I would argue: NOI growth, cap rates, and interest rates. In theory, when they're all working in the right sequence, we don't care. But they never work in the same sequence. And so what we've got right now is cap rates staying, at least in the multifamily space, relatively flat. Maybe 25 basis points, we could ask Brian, but maybe 25 basis points here or there, but relatively flat. Based on your last deal, Jason, I would argue pretty close to where you expected. Interest rates up in the interim, and NOI growth coming next year, not this year. So I agree with you, Cord. Over a holding period, it should all balance out. It's just we're in this inflection point right now where things are all different.
And Brad, I would argue one of the questions is there enough of an offset in the global capital that's looking at the U.S.? So if you consider that, pension funds, and as Peter pointed out in his piece, those allocations are exceeding 10%. You have the Nordics are increasing their allocations to real estate. Everyone is increasing their allocation to the U.S. So the question is that wall of capital that's looking at the U.S. Able to offset for those rises in
right? And rates? Again, it's a timing issue.
Yeah.
If cap rates stay relatively flat, because there is all this capital, and we did mention Japan, obviously a big player. We talked. James talked earlier about the high net worth individual capital, which I've never seen as much of it as we're seeing right now. All that's keeping cap rates relatively flat for the right kind of asset at a time when interest rates are going up. Jason, there is an 800-pound gorilla in the room which no one has mentioned all day long. Currency.
Right.
So you're faced with the reality that the hedging cost to do U.S. If you hedge, the hedging cost to do the U.S. means you're not in the U.S. I mean, 280 plus or minus 200 basis points to hedge euro against a dollar. What are you doing about currency?
We're not hedging.
You're not hedging.
We're not hedging.
All right, I'm going to come over here and pat you on the back. I like to hear this. Because the hedging costs are prohibitive right now. And so how can you get away with not hedging? Who's making that decision? Is that being made by Treasury someplace up here, or is Nicholas saying we're not hedging? Or are you making that call?
No, that's a decision made with our investors together. We're not the only asset class investing in the U.S. in residential. We all have more dollar exposure, and it affects the entire U.S. dollar exposure. So we decided the hedging that is in place is great to have, but we're not going to hedge for new investments anymore, or not going to hedge our new investments. But to come back maybe to the strategy at the beginning.
That's fine.
Our strategy is a long-term strategy. We believe in that the fundamentals are great in the U.S., especially for residential. And like Cord just mentioned, on the long term, it should balance it all out. I'm quite positive it will, and it's all about timing in real estate, as we all know, and we just want to be cautious and not just running out and deploying money in a certain phase.
I don't think anyone would accuse you of running out just to point.
Yeah,
I mean, when you take 15 years to come to the U.S., that's not like running out to deploy capital.
the part of that is before my time.
Yes, you weren't even born then.
Right, but in a long-term view, I believe it should pay off to invest constantly and look for opportunities. And there are opportunities around there. You just have to find them. It's hard. And like I said, on a long-term view, I don't think this situation we have right now is going to last forever. I think we're going to have to get used to lower cap rates and lower yields. I think so, but I don't think the combination, the timing, the way it is with the Eurozone, the US treasuries is going to stay like that forever.
Let's switch gears and talk about markets. And we.
I would.
Oh, all right.
I'm gonna interrupt again. Sorry.
No, David.
I'm Southerner. I have to say sorry all the time.
You're normally supposed to be, really polite Southerner. I'm surprised you're interrupting at all.
So I do think, just on your point on currency hedging costs, I would say in the last 6 months or so, that's been probably the biggest objection we've heard from investors in Germany about keeping them from investing either at all or more new money. I think what's also interesting, and Jason's a great example of how many investors are taking different approaches. We've heard some that say they have to hedge all of it, 100%, and that is completely putting them out of the market. We know some that are hedging half, roughly 50%, so to not at all. So I think it's interesting how different groups are taking different approaches and logic towards it, and how they're approaching it. And I don't know if these, for the groups that are out of the market, how long, if it continues, because I don't see that changing much in terms of the hedging costs.
If anything, get worse.
Right. So, can they be out of the market indefinitely? That's going to be interesting.
I guess that depends on where they can deploy their assets
Elsewhere.
or their capital into real estate someplace else.
Right.
I mean, again, we're back to this point. At what point are the yields in Germany so low that they can't accept those yields? Let's go back. I want to talk about your existing fund vehicle, and this is now my opportunity to let you market a little bit. You don't have to do it. I'm asking the question. So, and the possibility that you might have another fund. Let's talk about strategy and markets for the existing fund, which is sort of generally known here in Germany, I would say, or well known in Germany. Strategy of that fund and the market you're in that fund one. So let's start with that. What's the strategy of the first fund?
The first fund was a core strategy, 50% leverage. We bought new existing buildings in major markets. So we own in New York. We just closed the deal in Cambridge, Boston. We own in Charlotte, Atlanta, and Coral Gables, and in Dallas.
You quickly got to markets which I wouldn't normally have considered primary markets.
Yeah, it's a good mix between primary and secondary markets. And I think when I took investors to Dallas, and they were so surprised. They thought of Dallas as a city with a bunch of rednecks with carrying guns, and Dallas has...
That was Charlotte.
This was and Dallas, so Dallas actually has improved over the last 10 years. I mean, it's unbelievable. It's like has got a real downtown, has a vibrant bar scene, restaurant scene. So these secondary cities, I think, becoming more and more in favor for these investors. The second fund will pursue a similar strategy. I still believe...
He's not marketing. If there's a European regulator in the audience, he is not marketing a fund which is not registered. He's just talking about, in theory, what a strategy might be for a second fund if he were to offer a second fund.
Well, I just believe that in real estate, the old saying, location is still valid. So number one, I think in the US, what you see, there's a big shift into locations where there's knowledge. So is it Cambridge and Boston, Raleigh, San Francisco, New York, Seattle, where you have a very well-educated workforce. So you have to pick your spots there, and then I think you pick a couple of really growing cities with potential to grow. Someone mentioned Salt Lake City, and some people don't really know why Salt Lake City has so much potential. It's partly because of the Mormon religion there. People are very disciplined. They don't drink. They don't smoke. They don't drink coffee. The students are very focused when they go to school.
They speak about 50 different languages.
Speak
because
50
they go on
different
missions,
languages.
right?
So it's, I think, picking some of these cities, even Detroit has improved a lot over the last year. So I think
You're not telling me you're going to Detroit for Fund 2, are you?
I would look at Detroit. I don't know, but it's, but I think you have to balance your portfolio into primary markets, secondary markets, and you may add 1 or 2 cities where you really your research team has a lot of growth potential.
Would Fund 2 have a similar strategy? If you were to do a Fund 2, not that you are doing a Fund 2, if you were to do a Fund 2, would it be a similar strategy or a different strategy?
It would be a similar strategy with one exception. We would potentially use higher debt. I think, especially in the core space, people are capped at 40% LTV, and depending where interest rates go, if you can use a slightly higher risk leverage, like 60%, you can generate very appealing returns owning best assets in good locations. So I think we would consider potentially changing the LTV for our fund, but sticking to the primary strategy, investing in high quality real estate.
Okay, I'm going to stay
real
with
estate.
German funds and multifamily because we have another one right next to you. Jason, core strategy, what markets are you in now, and what markets might you consider in the next 18 months?
Okay, core strategy, I would correct you, a core plus strategy. We're invested in Atlanta and have bought recently an apartment complex in Denver. And we're quite happy and satisfied with Denver. Denver certainly was a market that wasn't our first choice when we defined our strategy. It was a market we said, yeah, we're going to look at, but you don't have to go focusing on Denver. But looking at the city and its development in the past few years, we are really pleased with the development and the fundamentals coming up in Denver.
Let me ask you a question which just popped into my head. You go to investment committee with an opportunity to invest in a market. Denver not being on your original list of likely ones, not a market you would have educated your investment committee about in advance. Does the fact that Denver is on the Amazon 20 list matter? Is it something that you would tell your investment committee to say, look at this, Amazon thinks it's big enough, it's an important enough market that we should look at it? Is it
Going to New York, by the way, Amazon.
What? Denver's not on the list?
No, but Amazon is moving to New York.
Where's Peter? Okay, that's a bet, guys. We heard this. All right. No, seriously, does that matter?
That's something we would communicate to our investors. That's something important. There's important news we would tell them, yeah.
David, based in Atlanta, I recognize you're operating on a national basis, but let's stay in the Southeast. We've heard Charlotte, Raleigh mentioned. Nashville came up earlier today. Is there another market south of D.C. and east of the Mississippi that people should at least be thinking about?
For multifamily or anything?
Pick a sector. I don't care. You're doing a lot.
We're active in multifamily, so that's lately. So that's where we're focused. Yeah, I think the Florida markets of Tampa, Orlando, those are two that rank towards the top of where we see things. South Florida, to some extent. I do think Florida will benefit on the margin for what's happening with the tax changes we've heard a little bit about. I think there's going to cause some migration out of the very expensive, we hear of, high net worth private wealth managers in New York that just said enough is enough. I'm not living in New York anymore. I'm going to Florida. Now, I don't know if that's causing a huge wave and how much that'll be, but even despite that, I think some of these Florida markets have some real attractive elements to them as well.
They're going to end up in Raleigh. We call them halfbacks.
Right.
They go to Florida and they come halfway back and they stop in Raleigh. So that's a halfback. Ted?
And you should mention, just for the benefit of the investors here, and part of that is related to state income tax, of which Florida has no state income tax.
That was one of the T's that we heard about from Frank. Ted, speaking of funds, when you were here last year, I sort of jumped ahead of the announcement that you were about to offer a new fund. That fund is now open, launched, actively being marketed with regulatory approval in Germany. So we don't have to worry about you doing what Cord was not supposed to do. Tell us what that fund is, strategy-wise, and then let's talk about where the assets are already and where they might go, where you might go for, because you're in a multi-sector fund. So talk a little bit about that.
Brad, it's a multi-sector fund. It's core plus, core plus, 60% core plus, 40% core. It's open-ended. We did a launch of about 600 million. It's focused on all 4 food groups, essentially multifamily, industrial, office, and retail. It essentially currently is invested in Atlanta, in DC, in the New York, New Jersey area, and on the West Coast, and it's designed really to give people a 9 to 12 net levered return over the period of time. And,
what leverage?
Of just under 50%. So, and it's focused on the top 20 metropolitan areas across the country. So it is, constantly out, whether that's buying, industrial in Dallas or looking at, office in Austin or Portland or.
Does the 20 vary by product type, by property sector? Because the top 20 would not be the same in logistics as it is in multifamily or office.
Correct. So there'd be variations within the top 20. So, for example, different markets, obviously, for multifamily and different markets for the industrial. But that fund is up and very active in the market.
Value add, I missed that. Value add strategy?
Core plus. Now, there is some, we have some value add components in that, say in the multifamily. Again, it's the restore to core plan, take the units, get the 18% return on cost, lightly fixing up units, that type of thing. So there's elements in that add to the core plus.
David, strategy-wise, what makes you most comfortable today, given pricing on core plus, value add, opportunistic? Where can you find value? Can you find it everywhere along the spectrum of risk, or where are you finding most opportunities to do on a risk-adjusted basis?
Yeah, it's obviously very tough. I think I'd break it into 2 parts. One, we have some investors that just by need and nature are very focused on current income. So that has led us to the core plus value, even value add multifamily. So we have some common themes, obviously here.
A lot of competition on this panel.
A lot of competition, out there everywhere. But so for that, for the people that need current income, at least with apartments, a little bit what Ted was saying, you can get a decent current income. Especially with the leverage you were able to get, and I think still you can, and then you can grow it some with some improvements. Where we also like it, if we have groups that are less sensitive to current income, is build to core. I still believe, and this is mainly also multifamily or even mixed use, it's not many, but there are some areas around the country that have real strong supply constraints that you can that have taken years to get approval. We're finding some of those where you're building them, and we think getting very attractive overall returns. But it takes time. You're taking a little bit of development risk, but I think it's worthwhile for these markets that have, again, very tight supply constraints.
One comment on the liquidity piece. In terms of multifamily, so our multifamily team is based in Boston. They are receiving between 8 and 12 offering memorandums a day across the country. So you can imagine in a week you've got 50 to 60 deals to look at across the country. So lots of opportunity to underwrite and define your niche investments.
Cord, take your German hat off for a moment, because Wafra also manages non-German capital, and you do things other than multifamily. So just talk a little bit about other sectors in which you've been active over the last few years and where you might see opportunity there.
Other than multifamily?
Other than multifamily. I know you're managing a multifamily fund, but somebody at the next desk is doing something different.
I think retail, still offers some opportunities. I think people still want to go shopping and want to have a shopping experience. I think, yes, you buy general stuff on Amazon, but to take your family to like a shopping center outside of New York and spend a day there, and get maybe a good deal, I think that's still valid. And some big malls still generate very healthy profits. On the office space, if you have a unique layout, design, if you really know what you're doing, and I agree with one of the prior presenters who said you really need to spend capital and make the space fit to the tenant needs. So I think there are opportunities. So Wafra is right now closing a deal in DC, an office deal in DC. It's going to be a value add deal. pretty still active on the retail side, but the focus is on multifamily, I would say still.